first you need to come up with another table. Total investment will be the equipment cost plus building cost plus land, which comes from here. So this information. That's the total investment. And then to find the profit per year, which is your gross income, you know how much profit you're going to make for one unit, and you know the number of units you're going to make per year. So if you multiply those two, that will give you the profit per year or the gross income. Okay. So from the gross income, you can make another table, the investment, which includes equipment and building. So in your case, if we have, let's say, 3 equipments, for each equipment, find out the depreciation using the straight line method. Okay? And then for the building, that's only one building, so again you can use the straight line method to find the depreciation. So if you add all those, this will be your total depreciation. So once you find the total depreciation, you can take half of it, or 50% as a write-off. So calculate tax on depreciation, which is a write-off. Okay. So you know the gross income. So from the gross income, you can subtract the write-off, the taxes and depreciation. That will be your net. This will be your net income. Okay. So once you have this information, then you can use the handout. There are 3 methods used to find out the return on investment, or it's in short, it's called ROI, return on investment. So basically, you're going to find what percentage of interest you're going to get back for the total investment you're going to put in. Okay? So there are 3 methods you can use. So on page 7, so I want you to do these 2 methods. So 3 methods: payback method, accounting method, discounted cash flow method. So I want you guys to do these 2: simple payback, present value payback, and then the discounted cash flow. The simple payback method, the example is given. Suppose you have an investment of 400,000, and then if you are making every year, you are making a profit of 100,000, 150, 150, 120. To find out what is the payback period, you basically, the investment is like a loss. The loss is given in parentheses. So from the loss, whatever the profit you are making, the cumulative cash flow, so probably at the end of 3rd year, you are break even. And then you start making profit. So this is the simple payback method. The next method, present value payback, is basically you convert this profit into the present value. So how much it is worth today, this 150,000 after 2 years, how much it is worth today. So to find out that, on page 2, we have this equation here. This equation is you can use to find out what is the present value. So where this, for yes, we can use the 100,000, and then you can find out what is the present value for that, which is on page 8. For 100,000, it is worth today 92,000. 150,000 at the end of 2nd year, its present value is 131. And then this 150 at the end of 3rd year, its present worth is 122. And the 120,000 is present value is 91. So now use this present value with, on your investment. So now the payback period is about 3.5 years, which is in between these two. Okay? So do this method and this method. This simple payback and the present value payback. Okay? And then you should do the discounted flow method, which is on page 10 and 11. So you can build this table with all the information you have. You should be able to build it. So here the 20,000 is your investment, which comes from here, total investment. Okay. And then these are the profit for this. The life of the machine is 8 years, and they are making profit is given here, which you have the information, which is the profit, the gross income, you know that. And then they are finding the taxable income for the depreciation. You take the 50% of that is the write-off. Now you subtract this write-off from the gross income, so that will give you the net income here. So 5,000 minus this is 3,750. 5,750 minus this will be this. So that's what I asked you to do here. So find the depreciation and take 50% of that, that's your write-off, and then find the net income, which is the gross minus the taxes and depreciation. Okay? So then use this table on page 10. So the 20,000 is your investment, and this is the net income, 3,750. If you look at this table here, this 3,750 is here. This last column. So this information you transform as the first column here. Okay? And then to find the discounted rate, trial and error method to find out when the cash flow becomes positive or when it becomes equal to 0. So here they are starting with 9%. So at 9%, you are going to use this equation again, P equal to Sn divided by 1 plus I power n. So find out for 3,750 with 9% interest rate for 2 years, n equal to 2, you can find out the present value.
Sn is
which is the 3440.
the income, right?
This is the net income.
Okay.
After taxes paid. So for this net income, you need to find out the present value for the net income. Using the equation, you can find this. Okay. So now you subtract 20,000 minus 3440. It gives you this. This is the cash flow. Then this minus 3472 will give you 13,000 cash flow. So the cash flow is decreasing depending on the profit. So at this point you see from negative it becomes positive. So it's somewhere here. Then to find out that, they increase the percentage from 9 to 15%, and the cash flow becomes somewhere in between these two. And again they try 20%. The cash flow after 8 years, it is still negative 775. And then if they make it 19%, it is negative or loss, negative 101. Then you do the somewhere close to 19%, and they found out it is about 18.85%, 18.7. It is about 18.85%. The cash flow becomes zero. So this tells you that with a 20,000 investment in 8 years, you get a rate of return is about 18% or close to 19%. Okay, so follow this example, but apply the numbers what you have from manufacturing cost. So show progress on this next week, and then the completion of manufacturing cost next Friday.